Hello everybody and welcome to this new video on HIMS. So I've taken the time to make a longer video about all of the takeaways from Q3 as well as the main takeaways from the earnings call. So I'm just gonna go through a recap of the quarter and my general thoughts. And this should be an interesting video. So let me just get started with the growth, the state of the growth for HIMS. So for a company like HIMS, growth starts with the subscribers, right? The subscribers precede the revenue. And when it comes to the subscribers, they had 1.426 million new subscribers, not new, million subscribers. So that's an increase of plus 9.69% compared to a 1,300,000, so 1.3 million subscribers in Q2. So a 9.69% increase in subscribers. They have now a little over 1.4 million. So what's outstanding to say here is that the subscriber growth, the number of new subscribers, is increasing at a faster pace. It's increased at a faster pace in Q3 than in Q2. You can see Q1 versus Q2, it had only increased at plus 7.5%. So right now we're at plus 6.69%. If you annualize that, if you take a snapshot of this growth and annualize it, right, you get 45% instant annualized growth in subscribers. So outstanding. And also we have new markets coming like weight loss, and I'll cover this at the end of the video, but you can see that this is a company that has a major roadmap. And right now they're pushing, a lot on weight loss, but before the weight loss craze, you may remember that they were also developing programs for testosterone treatment and programs for menopause, and there's other programs that they have coming. And so the number of subscribers joining the platform will inevitably grow as they include more and more programs. They have a pretty clear roadmap. So that's it for the customer growth. Now, what about revenue? What about revenue growth? Well, revenue growth is a similar story. So as we know, subscribers precede revenue, but once you become a subscriber, right, sometimes they'll become 1 month subscriber, and after 1 month, they'll become multi-month subscriber. And in general, a subscriber stays for a very long time. We know from Yemi mentioned 2 calls ago, the CFO mentioned to us that there's a lot of subscribers that still have their subscription from 6 years ago when the company got launched. A subscriber can stay a decade and generate a lot of revenue. But as far as revenue, so turning these subscribers into revenue, we can see that same increase in the quarter, that same acceleration. We're at plus 9.13% quarter over quarter, Q3 from Q2, while Q2 from Q1, we were only at plus 8.9%, so a slight increase. So quarter over quarter growth rate, if you annualize that, you're at 42%. But the analysts are expecting 57% forward growth. And me too, I'm expecting higher growth going forward because we know we have the weight loss category coming in Q4. The weight loss category is coming in Q4. If you know anything about weight loss, that's typically in very high demand in January, right after the holidays. So they're going to launch it right before the holidays, and analysts are very hopeful about this. And me too, I'm hopeful about this. And I think they could have a lot of growth. And as a matter of comparison, a company that's often used as a peer for HIMS is Teladoc. If you compare Teladoc's analyst predicted growth, you only have 11%. This is one of the main advantages of being HIMS. With HIMS, you don't have to deal with the complexity of reimbursement. You don't have to deal with the complexity of insurance. And as a result of that, you are free to grow. Your growth is untamed, which is amazing. All right, let's talk about profitability. So as you know, if you know me, I don't care too much about profitability. I just want the company to be cash flow positive or, near cash flow positive, plus a few million one quarter, minus a few million another quarter. That's what I care because I invest in product adoption, right? My goal is by the time the company is big enough to return capital, it doesn't grow enough for me. And so I want to move on to a new company. That's my general style of investing. But let's face it, I'm one of the only few persons who thinks like this out there. Most people, and the market in general, especially right now with interest rates, the way they are, they care about short-term profitability. They care about next quarter. That's why HIMS has been driving this profitability upward. Adjusted EBITDA profitability at 12.3 million came in the high end of their range, and they've updated their guidance for Q4 and for the full year at between 43 and 46 million in profitability. So absolutely outstanding here. And they also noted in the call that they would be profitable on a net income basis between Q1 and Q2 of 2024 on a net income basis. And so depending on when they execute this buyback and depending on how much stock-based comp there is, it could be GAAP profitability, which the market cares even more than just net income profitability. The market loves GAAP for some reason. And so that is just the way it is. I just want to point out another thing which it just occurs to me. I forgot to put it in these slides. I want to talk about the buyback. There's a $50 million buyback that's coming, right? So over the next 2 years, they authorize a $50 million buyback. My guess is that as long as the stock is trading in the $6 range, my guess is that they're going to execute that buyback. And I'm really hopeful that they will. And if they execute that buyback, you actually, I calculated, if you executed the $50 million buyback in 1 year, you would eliminate about 70% of the stock-based comp. So about 70% of all of the dilution would be eliminated by a buyback. And I think that's also why they are thinking about doing a buyback, because in my view, you want to keep that stock-based comp to motivate your employees, right? Employees are more motivated when they get stock, because stock goes up and it's advantageous, and you can also buy it at lower prices. I don't know exactly the plan that they have, but I know in management, when you get to higher levels of management, stock-based comp motivates you. And the fact that they just buy back the stock on the other end is what a lot of startups do, and I think that could be a beneficial thing to do to the shareholder, especially at these prices, right? I wouldn't like the buyback if the stock was trading at 18 or 24, right? Which would be much closer to the fair value of this stock, in my opinion. No investment advice. Let's talk about value and let's talk about valuation for a second. And let's also talk about that long-term guidance, which they still have not updated. Analysts rightfully pressed them on the long-term guidance on the call, because we all know this is sandbag. This is fully sandbag. So 2025 trajectory. So I had assumed that we would get to that in February of 2026 when we'd find out, because I had assumed they'd reach this by the end of 2025. So I'm now going to assume they reach this guidance by the beginning of 2025. And it's not that far-fetched if I'm predicting more than 50% growth in revenue over the next 12 months. It's not that far-fetched at all. So let's assume in 1.25 years, right? So 5 quarters, let's assume that they reach this guidance. So if they reach this guidance, I'll begin with that, and then I'll show you my own valuation. But if they begin this guidance, so the forward enterprise value over EBITDA for this stock, right? So enterprise value for this stock is 1.22 billion right now in after hours, after the 6% increase in the stock price. Okay, so 1.22 billion divided by 1.2 billion in revenue, and we have a 25% adjusted EBITDA margin. That's the assumption, right? I'm really putting it right in the middle at 25%. They could do more. You're getting at a 4. You're getting a ratio of a 4.06x forward EV over adjusted EBITDA ratio, which gives you a forward adjusted EBITDA yield of 25.59%. This is dirt cheap. This is getting pretty similar to Stone, in my opinion, which is the only other stock that I know of that delights both growth investors and deep value investors, right? Stone is the one stock that pleases Warren Buffett and Cathie Wood. Could HIMS be a stock like this? I think so. I've also updated my regular spreadsheet, my what I call the product adoption spreadsheet, kind of, where I ask the question, how much am I paying for each percentage point of forward growth? What's the cost for that forward growth? And I get to my metrics, which is enterprise value over gross profit over revenue growth. And you update the revenue, right? They've posted great numbers on the revenue. The gross margin is up by 2%, well, 3% almost compared to what it used to be. So when you update all of this, what you're getting is a stock that is still the cheapest stock I've ever seen in my spreadsheet in the way I value stock is. This is still the cheapest stock, even with the 6% upside. But rates are up, so this market doesn't pay attention. Even though on Friday, when rates were down, you had stocks who provided way worse results than this. We're up 35% 35-25%. The randomness of Wall Street creates opportunities, and I will be buying the stock tomorrow if it is only up 6%, because in my view, this is de-risked at this point. Like the thesis is on track, and that's the 5th quarter with no red flag where the thesis is on track, the 5th quarter, and it's accelerating in Q3. So anyways, no investment advice again, but that's a cheap stock in my view. Let's talk about the marketing spend. So analysts also pressed them quite a bit again on the marketing spend and the marketing expense. And why do analysts do that? Because marketing, because in the eyes of analysts, marketing spend is an expense. And it's an expense because they got their MBAs in finance and they learned in accounting that marketing was an expense. It's OPEX, right? And that's rules from the 70s, really. When you advertise to sell a car, the car was sold, and for the next 10 years, you weren't going to sell another car, and you spend $5,000 in ads to sell a car, that's a cost. But that's not the same for HIMSS. That is not the same for HIMSS because HIMSS is a recurring revenue business model. So the modern view of business and many businesses in tech, the modern view, in my view, is marketing spend is not an expense. It is an investment. You should really take that $1,000 customer acquisition cost and amortize it over a 10-year period. But this is just not the way accounting works. So you have to take the loss right away. It almost makes you wonder how much more money would be spent in marketing by businesses if you didn't have these archaic accounting views of how marketing spend should be categorized. But let's look at it through the archaic lens, which is the way Wall Street is going to judge the stock. So if we care to know about the direction of the stock, I'm pleased to report that there's some positive news per Wall Street. So they've acquired 126,000 new subscribers for Q3, and they've paid $116 million in marketing spend. So that's $920 per subscribers. In Q2, they had acquired 91,000 new subscribers, and they had paid $107 million in marketing spend. So the Q2 cost, very simple back of the napkin math, was $1,176 per subscribers. So that's a marked decrease. That's a decrease in the average cost per new subscribers. Now, of course, that's not how you calculate customer. I mean, it's a very basic way of calculating customer acquisition cost because we don't know fully everything that is in marketing. You know, a lot of that marketing could be marketing research. A lot of that marketing spend could be general brand building that you don't necessarily associate with gaining a new customer. It could be some form of customer service sometimes included in marketing. There's many forms of marketing spend that are not always directly targeted at acquiring new customers. So they know their internal marketing costs. What we see is a figure that is much higher than what they likely see, which is why they do keep telling us, and they did tell us this in the call, the payback on marketing spend is under 1 year, and we've heard them before, although they get a pushback. Whenever they say this from analysts, they get pushback, but we've heard them before on the record say multiple times it was under 6 months of return on marketing spend. And if you use a narrower definition of customer acquisition cost and how you calculate it and remove things like, general brand building activities, if you remove that, then you can get to a lower cost per marketing spend. Of course, it differs by category, by product, by channel. I think this is in general a good direction for Wall Street to see the average cost of new subscribers decrease. Let me move on to another good news, which is really the exponentiality of the growth. So the exponentiality of the growth is, can we possibly envision a future where this business grows even faster? Really at the heart of this S curve, really at the curve, the curvilinearity of the S curve, that makes any sense. Well, you get to that when you get somewhat of the situation that you have for HIMSS. So look at HIMSS. So their average online revenue per subscriber is up 6%. The average order value is up 19%, and of course the number of customers is up 56%. So multiply the number of customers, right? That increases. And also how much they order, each of these customers, how much they order year over year also increases. When you multiply the two, that is how you get some exponentiality in the growth. And we definitely saw in Q3 some of that acceleration. So it's not only getting more customers to buy your goods, but also getting better at selling them more goods. That's the classic cross-selling that we see in so many modern-day businesses, and that is what HIMS is, in my view, showing signs of succeeding. Also, the key is turning, and that's why we have a big difference between the average order value at 95 and the monthly revenue figure per customer is at $55 a month per customer. That's one of the grand quests of HIMS, is to try to turn this single-month subscribers, people who are just trying it out, into multi-month subscribers. And right now, 21% of the customers are 1 month, 79% of the customers are multi-month. So they do have some churn. Which is why some of that marketing spend can be seen as high by some analysts, but the churn is not that high. They have 79% of those folks, of those 1.4 to 6 million folks, 79% of them are there with monthly recurring subscriptions, like a Netflix, right? So think about that. That's 1.13 million people paying $55 a month at an 83% gross margin. Right? This is a business that if it wanted to stop growing, turn off advertising, and just turn on profitability, this is a business in this market with how many value folks are out there. In my view, the stock would really benefit. But the market doesn't like marketing spend. And because they don't like marketing spend, they sell the stock, because this is future-oriented. This is a stock that is investing in its future. All right. Let me conclude this video with 4 points about the growth initiatives, which is what I care the most about. I'm invested in HIMS for the revolution of healthcare, what people call healthcare, what I call sick care. I'm investing in HIMS because I want to see healthcare and not sick care anymore. That's my thesis for HIMS. My thesis for HIMS is the introduction of healthcare, if you call currently what we have sick care, or better healthcare if you call what we have healthcare, right? Okay, there's a lot of good things going on. First of all, there's meaningful growth in the Earth platform. They mentioned it on the call. I couldn't copy and paste the part on the call because I couldn't find any transcript that has already been published yet. I'm recording this video in the evening. It will be released in the morning after, right? But they're doing well. In the call, they said they're doing well. Hair loss offering is doing well with women, as well as depression offering, resonating with female consumer. The Hearst platform is doing well and has more than doubled year over year. That's point number one. Point number two, their customized solutions are on the rise. It's worth mentioning that 20% plus of subscribers, so of the 1.4 million people we just mentioned, 20% plus of those use personalized solution. Why do we care about this? Or rather, why does the market care perhaps a little more than me about this? Is because you create some sort of a moat, which is if you end up loving the product, then you can't really switch to another product, right? So if you use a personalized solution from HIMS, then you can't switch to the other product. Now, I would say, in general, you have to be careful, because that gets you back into the rent-seeking scenario where you have a patent and you can charge, an arm and a leg for your product, and then your customers hate you. I want to point out that HIMS is not getting into this, because HIMS is actively reducing prices on many subscriptions, which is exactly what a 21st century business should do. 21st century businesses need to be loved. They can't engage in rent seeking, just like we did in the 20th century, because Gen Z doesn't fall for that. Millennials don't fall for that, and that's really, customer centricity is really what the customers have come to expect in the era of Amazon. And I'm glad to hear this CEO on the call talking about customer centricity and why it matters, and providing a better solution, better care. So yes, personal solutions are great because they make customers less likely to switch to another brand. But I would say that's the lesser reason to like this. The better reason to like this, in my view, is that they are more effective and they make your customers happier because you have a solution that is perfect for them and that matches them perfectly, right? Nobody's the same. Why are most of the drugs the same if nobody's the same? That's customization of healthcare, and that's something that is possible with compounding pharmacies like those that HIMS has. Let's talk about MedMatch. MedMatch is a great improvement in their algorithm. In my view, it's a win-win. It's a win for both patients and providers. So how does MedMatch work? So patients get prescribed better drugs, that is, drugs that are more likely to work, by their providers. So they use machine learning to recommend drugs based on pre-filled responses and demographic data that has been in demographic and other sorts, lifestyle data, all sorts of data that they collect on their customers. They use that data to predict the drug that is the most likely to work for that person at that moment for that health issue. And then, of course, the provider can pick any drug they want to recommend. But with the recommender system, they have more information that makes it easy for the provider to pick a drug. It makes it easy to find and highlight the best drug for the customer. So this recommendation system on the eyes of a provider really increases how many patients a provider can help, because the provider doesn't have to on their own define what to recommend. The system helps them recommend quicker. So that helps the provider on one other end. And really the provider, then their main expertise, the main value is to eliminate those edge cases where the recommender system really does something wrong and recommends something wrong, right? So their main issue, their main help is really to help for those edge cases where the recommender system fails, which over time, obviously, they won't fail as much. And then the patient is happier because the patient has better outcomes, because it is AI that is recommending your drug and not a doctor, right? And we know, doctors can make mistake. AIs still can make mistake, but as we go through the years, AI is going to get better and better and better and make less and less and less mistake. And the future, provided that regulation moves that way, the future for a company like HIMSS is obviously an AI-only provider. And if you have an AI-only provider, right, an AI-only doctor or nurse practitioner, think about the coming collapse of healthcare costs. You've just eliminated 50% of your healthcare costs if you remove that part of the process. So this is a blessing, really. This company creates a lot of value for society. This is not just something for shareholders. It goes beyond the shareholders, and that's why if you look at the reviews, if you look at the App Store, customers love these companies, and you don't even need to look at the reviews. You can just look at the product adoption. Product adoption is tremendous. So we have a clear signal that the market likes this. And lastly, the last growth initiative that I want to talk about, which the market is very excited about, is the weight loss drugs and the weight loss treatments. And of course, this is pressure from Wall Street because the GLP-1 agonists have triggered a lot of interest. There's a lot of general interest to lose weight with drugs. And as they mentioned on the call, not only are people interested in GLP-1s, but the CEO thinks they're more interested in medical solutions given by providers as opposed to just going on a diet. They're interested by medical ways to lose weight. And of course, we don't know of a product yet, and I don't want to take it away from HIMSS. Not that I pretend to know what it is going to be, but I have a little feeling it could be more established compound. Like, for example, a popular one is metformin. So metformin is a popular one that's a molecule, that's a pharmaceutical compound that has been around for the longest time, and it's usually for heart health. But with metformin, it also has the nice side effect. It wasn't designed to be a weight loss drug, but researchers have found a link between the drug and weight loss. Well, yeah. And then you find out that you have people who are not diabetic who take metformin, and metformin is much more widespread than GLP-1s. And of course, I think this is a better fit, in my view, for HIMSS. And why is it a better fit for HIMSS? Because GLP-1s agonists are risky for HIMSS for multiple reasons. First of all, they're not a good fit for the brand, in my view, because they're very expensive. $200 a shot? That's pretty expensive. That's not a good fit with a brand that collapses the cost of healthcare and revolutionizes the cost of healthcare and is entirely out of pocket. So that's number one. Number two, if you follow GLP-1s, you may see there's been some people raising issues with the fact that actually you lose weight. Yeah, you get lighter, but you also lose a lot of muscle mass. And of course, that doesn't really fit with our mission, because if you lose weight, but it's mostly muscle mass that you lose, it's not a healthy you anymore. It's just a lighter you. So that's one. And then the last one is the ethical concerns, because of course, if everybody buys these drugs for weight loss, you have shortages for diabetics. So you have ethical concerns. And Hims, being the biggest company in the space, if they were to do GLP-1s, and if some of these ethical debates were to come back to life, if those shortages at pharmacies for people who actually have diabetes were to come back to life, I don't know, after Christmas in January, that were to come back to life, imagine if Hims, the biggest company in the space, is under the backlash, right? That could really hurt them. There is obviously no concern for a compound like metformin, which is much more common, and there's more chemical compounds that are also associated with weight loss. So I think that's the route that we are going to take, and I think this could be big. I'm not the only one. That's what the analysts think. That's why the analysts are predicting greater growth in 2024 than we have seen over the past 12 months. So this is the bulk of my updates. This was not investment advice. This is just entertainment. I'm very happy with this company. I'm surprised it's only up 6% after hours, but it is the way of the market that was to be expected. Please like if you can. I appreciate it. Please subscribe. Have a wonderful day.